Welcome to StockTok's deep dive into Bank of America Corp. Bank of America is one of the largest financial institutions in the United States, providing consumer banking, wealth management, and global markets services to tens of millions of clients. At the time of recording, the stock is trading at 53.91, sitting well above its 52-week low of 36.49, and within reach of its 52-week high of 57.55, suggesting the market has been repricing this name aggressively to the upside. The 14-day RSI, a momentum gauge, reads 68.4, approaching overbought territory, while the 50-day moving average of 50.53 has crossed above the 200-day moving average of 50.7, a technical signal analysts often interpret as constructive. Let us work through the fundamentals, scene by scene, starting with a quick business overview. Bank of America generates revenue primarily through net interest income, the spread between what it earns on loans and what it pays on deposits, alongside fee-based businesses including investment banking, wealth management, and trading. Its moat rests on an enormous deposit franchise, a nationwide branch network, and deep relationships with both retail and institutional clients. The StockTok score stands at 36 out of 100, a caution signal, with valuation scoring just 4 out of 20, health at 7, profitability at 9, growth at 8, and smart money at 8. A mixed picture, to put it plainly. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Bank of America trades at a price-to-earnings multiple of 13.34 times trailing earnings. On the surface, a seemingly modest figure for a large-cap financial. But the PEG ratio, which adjusts that earnings multiple for growth, where a reading below 1 is generally considered attractive, comes in at 2.26, implying the market may be paying a premium relative to the company's earnings growth rate. The EV to EBITDA metric is not applicable in a conventional sense here, as bank financials are structured differently from industrial companies, a nuance worth understanding before making peer comparisons. The Guru Focus Value, an independent intrinsic value estimate, sits at 46.62, against the current price of 53.91, implying a margin of safety of negative 15.64%. In other words, at the time of recording, the stock appears to trade at a premium to that internal fair value estimate. In our view, Wall Street analysts at the time of recording have a consensus mean target of 62, drawn from 23 analysts, with a high target at 71 and the low at 56, suggesting the street sees meaningful upside from current levels. The next earnings report is due July 14, 2026, with the consensus expecting earnings per share of approximately 1.10, ranging from 1.07 on the low end to 1.15 on the high end, a near-term catalyst worth monitoring. In terms of competitive moat, Bank of America's switching costs in consumer banking and its scale advantages in capital markets give it structural durability. In our view, market sentiment around Bank of America, as of the creation of this video, leans broadly neutral. Bank earnings have demonstrated resilience, but analysts at major houses have flagged limited broad equity upside, tempering enthusiasm. The setup looks stretched on a pure valuation basis, in our opinion. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency, comes in at 6 out of 9 for Bank of America. That is a respectable reading, sitting in the moderate to healthy range, and suggests the business is passing more fundamental tests than it is failing. However, the Altman Z-score, a model designed to assess bankruptcy risk, where scores below 1.8 historically flag distress, registers at 0.00 here. It is critical to note that the Altman Z-score is not a reliable diagnostic for banking institutions, whose balance sheet structures, dominated by deposit liabilities and loan assets rather than traditional industrial capital, cause the model to produce misleading outputs. Analysts and credit professionals typically set this metric aside when evaluating regulated financial firms. What we can assess directly is the cash-to-debt ratio of 0.65, meaning the company holds 65 cents of cash for every dollar of debt, adequate but not fortress-like. Debt to equity stands at 1.28, reflecting the inherent leverage that is structurally normal for large commercial banks. Interest coverage is not applicable in the traditional sense given bank accounting conventions. In our view, the balance sheet reflects the leverage profile you would expect from a well-regulated, systemically important financial institution, neither alarming nor exceptional. Next up, profitability. Is this business actually making money efficiently? Starting with return on invested capital, the return a company generates on every dollar of capital deployed. This metric is not conventionally reported for banks in the same way it is for industrial companies. So we look instead at return on equity, which measures how effectively management is generating profit from shareholders' invested capital. Bank of America posts a return on equity of 10.54%. For large global banks, the general institutional benchmark hovers in the 9 to 12% range, so that reading places the company in a competitive but not exceptional position. Return on assets, net income as a proportion of total assets, stands at 0.93%, again broadly in line with what you would expect from a major money center bank, where asset bases are enormous relative to earnings. The net margin, the share of revenue that ultimately reaches the bottom line, is a solid 27.32%, which reflects meaningful operating discipline. The free cash flow margin, cash generated after capital expenditures as a share of revenue, stands at 10.87%, a respectable figure that gives management flexibility to return capital to shareholders. Gross margin and operating margin are not reported in standard form for banks given the nature of financial firm accounting, a structural limitation of the data, not a red flag. The profitability picture, in our view, is adequate but not standout. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Bank of America has delivered revenue growth of 6%. Extend that window to 5 years, and the figure rises to 8.7%, suggesting that while recent momentum has modestly decelerated, the longer arc of the business has been constructively expansionary. For a financial institution of this size, one of the largest in the world by assets, generating mid to high single-digit revenue growth is meaningful. It reflects the tailwind the company received from higher interest rates boosting net interest income, as well as steady contributions from its wealth management and markets divisions. Book value growth over the trailing 3 years comes in at 7.9%. Book value, the net asset value of the company on a per-share basis, is a particularly important metric for banks, as it anchors intrinsic value estimates and Tier 1 capital ratios. A book value compounding at nearly 8% per year is a constructive signal that management is retaining and reinvesting earnings effectively. The dividend yield at the time of recording stands at 2.04%, a modest income component that, when combined with share buybacks, forms part of the total capital return proposition. The data suggests growth has been real and consistent, though we would want to see whether the rate environment continues to support net interest income going forward, as that is the primary driver of the revenue line for Bank of America. Now let us talk smart money. What institutional capital is actually doing with this name? 37 top-tier guru investors currently hold positions in Bank of America, which is a significant count, and speaks to the enduring institutional appeal of this franchise. Among the most notable holders is Warren Buffett through Berkshire Hathaway, for whom Bank of America represents 10.38% of reported portfolio weight, a substantial allocation from one of the most scrutinized long-term investors in the world. That said, Berkshire has been reducing its position by 8.94% in the most recent reporting period, and that is a signal we would not dismiss lightly. Lai Lu of Himalaya Capital Management holds Bank of America at 16.08% of portfolio with no change in position, a steady hand. Harry Byrne of Sound Shore has reduced by 16.05%, and Tweedy Brown has trimmed by 1.74%. Francis Chu of Chu Associates holds with no change. The direction among major holders is therefore one of measured reduction rather than accumulation, a nuance the data makes clear. On the broader institutional picture, only 19.8% of 13F filers, the mandatory institutional ownership disclosures, are net buyers, a figure well below the 50% threshold that would signal broad bullish conviction. Insider ownership sits at a low 0.3%, meaning management has minimal skin in the game relative to the share count. In the most recent 3-month window, insiders recorded 0 purchases and 6 sales. Taken together, the smart money picture warrants caution. In our opinion, the pedigree of the holders is exceptional, but the directional flow is net reducing. And finally, the verdict. Let us bring it all together. On valuation, the data suggests Bank of America is trading at a premium to its Guru Focus intrinsic value estimate, with a PEG ratio above 2. The setup looks stretched rather than compelling on a price discipline basis, in our view. On financial strength, the Piotrowski score of 6 out of 9 is adequate, and the leverage profile is structurally normal for a regulated bank, though not a fortress balance sheet. On profitability, return on equity of 10.54% and a net margin of 27.32% are respectable for the sector, without being exceptional. On growth, mid to high single-digit revenue expansion over 5 years is solid for an institution of this scale, and book value compounding near 8% adds further credibility to the long-term thesis. On smart money, the quality of holders is elite, but the directional signal from major gurus including Berkshire is one of reduction, and institutional 13F buyer participation at under 20% is well below the threshold for broad conviction. Our overall read, based on the data as it stands at the time of recording, is that Bank of America is a high-quality institution facing a valuation setup that demands careful scrutiny. One might argue the case for a position at a better entry point, but the current premium to intrinsic value and the net-reducing posture of smart money give us pause. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Bank of America Corp. Like and subscribe so we can keep providing you with no-nonsense data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.